Hello, everyone. Welcome to the For Investors podcast. I'm Andrew Gay, along with Gilbert Pies and Zachary Green, and we are the Texas Hill Country Advisors. We're independent financial advisors based right here in the beautiful Texas Hill Country, and we're here to talk to you a little bit about what's going on in financial markets and give you our opinion. So this week, let's start by talking about the news at the forefront of all of our minds, which is the most recent rate cut by the Federal Reserve. Dun, dun, dun. Okay.
Yeah, unless you were living under a rock the past few months, the rate cut was widely anticipated, but there was a lot of question about how much it was going to be and if it was going to be one. At least from this corner of the room, we were wondering if they were even going to cut rates, but obviously they did.
Yeah. So let's talk a little bit about that. What was the reasoning seemingly behind why they wanted to or needed to cut rates?
Well, let's go back to the previous meeting, not this one that they had made the announcement, the one before. Jerome Powell at that meeting opened the door basically to a rate cut. Before that, he was pretty opposed to a rate cut because inflation still is not going towards their 2% target. In fact, it's been slightly creeping up over the past few months.
That's a great way to say that, because it's not like it's close to their 2% target. It has actually been moving the opposite direction the last several months.
Yes, but I think at the last meeting, he mentioned that the labor market was starting to weaken enough that full employment was then becoming an issue for them, not necessarily inflation. So it looks like they probably just agreed to meet in the middle somewhere. I would think that he was probably of the camp that no, we don't need to cut rates yet. But there were several people on the committee that indicated that they thought they should cut rates substantially, 50 basis points. And the 25 basis point cut, I think, was probably like their compromise position that said, okay, we'll acknowledge that there's some weakness in the labor market. We don't want to go overboard and cut by 50, 75, or 100 basis points like some people in the administration want. Let's just at least start. And then also this week, after the rate cut announcement, the idea was put out there that maybe there's 2 more rate cuts to follow by the end of this year.
Yeah. And so when the Fed cuts rates, like if we look at this week and what's happened leading up to this most recent rate cut, the stock market was up this week. So there's some optimism that comes out of that, but it seems a little counterintuitive from the standpoint that if the Fed is cutting rates, that usually means that they see some signs of a weakening economy. So on one hand, that kind of makes you scratch your head and say, well, isn't that not necessarily that great, right? But I think it can be interpreted a couple different ways. I think one of the reasonings that I've seen about why the stock market has been up recently in anticipation of this rate cut and after is because that it could be a favorable environment for corporate earnings going forward. And of course, the corporate profits is what props up the values in the stock market. So that reasoning kind of makes sense. But at the same time, if the labor market is weakening and the Fed thinks that the economy is going to continue to weaken. Now, remember, this is with the backdrop that we've talked about a recession manifesting itself for the last 2 years and it just hasn't happened really. That maybe spells a little bit of uncertainty for the same corporations that think that maybe a lower rate environment is a favorable environment. So will it be a wash? Will one weigh on corporations more than the other? What's your take on that?
I don't know. It's hard to tell, but like we were talking about before the show this morning, we talked about, why is the stock market, the equity market going up and interest rates are being cut? Generally, that's in the short term, lower interest rates are not good for the market.
Right.
But I think what the equity market is doing is saying, okay, we're finally getting the rate cuts that we want. And we think that any slowdown or recession we're going to have is be very short-lived, and that the corporate profits and earnings will rebound quite quickly and start to recover substantially. And the market, being an anticipatory mechanism for the future, is saying, hey, whatever's happening is going to be short-lived, and we're going to see sunshine and roses over the next 6 to 12 months. And you want to get into the market when it's quote unquote down, even though it hasn't really been down.
Yes, it's at
and-
all-time highs, but yeah.
Yes, and if all things being equal, if today was the end of the year, the market, the Dow, the S&P, and the Nasdaq would all three be up double digits, which is pretty freaking amazing considering all the volatility we had earlier this year. What is that going to do for the rest of the equity market? I don't know, but as we've talked about many times before, not all equities are created equal, and you'll have different sectors or different pockets of the equity markets continue to outperform. You'll have some be weak, and you'll have some kind of do a moderate amount. So who knows? It's hard to know as an investor. You have to. This is a good example of why you need to be diversified.
Sure.
Diversified, because one does not know what's going to happen, what's going to do well, what's not going to do well. And if you're diversified, you kind of cover all your bases, and intentionally, you know that you're not going to do as well as maybe the stock market overall.
Right.
But you're also hedging your bets and saying, hey, listen, I'm trying to protect my downside.
Yeah. And if you look at something like, as you were talking about that, I was thinking about the Russell, the small cap, Russell 2000, that thing's up. It was up 2.5% yesterday. It's up something like 15% year to date now, but it just juiced that return over the last like 3 to 6 months, really 3 months. And so that sector of the equity market has outperformed some of the other ones just off of the back of the hope with lower interest rates or lower interest rate environment. And historically, that sector does well when interest rates go down.
Small caps typically do well at the beginning of a growth cycle.
Yeah.
I guess we could argue all day whether or not we're at the beginning of a growth cycle, because I thought that's what we had a year and a half ago, 2 years ago.
Yeah. But that also highlights the uncertainty, I think, the level of uncertainty that's out there right now. So, okay, so we kind of touched on, why the Fed's cutting rates and some of the signals that it sends to the markets, but let's talk a little bit about what's happened historically. So I think we were talking about before we started this, Zach pulled up a nice, neat little chart for us there, and that's from Visual Capitalist and their data from, it's just S&P data, but it's from, who's it from?
Pinpoint Macro Analytics.
Pinpoint Macro Analytics.
Mm-hmm.
Okay, but it's
Say
just
that
based
real
on,
fast 10 times.
It's just based on the S&P, but there's been 12 or 13 rate cutting cycles since 1973.
Mm-hmm.
And it gives 3, 6 month and 12 month numbers. And so from the, we look at like the 12-month number. What's the first thing that kind of stands out to you on that?
On average, they're positive. It comes out to 5% on average, but none of them are around the 5% mark. It's either up pretty good or down pretty bad.
So but most of them, I think there were only 2 negative 12-month periods following the start of a rate cut cycle, 2 or 3?
4.
Four
if we go back to 73.
Okay.
So, and those do weigh down the average quite a bit. Like the one in 73 was a negative 36%. So
yeah, because the following
bit of an outlier.
12-month period wasn't good. And I think one of them was 2007, and we all know what happened 12 months after that. So I think,
and that was a down 27%. So another one weighing it down. But if we look at 2019, the first rate cut happened, and then 12 months later, it was up 14.5%.
And that had COVID in there.
Yes, it did. And then we can go back to 2001 as well. We'll see a different cycle. After the 12 months, it was down 14.9%.
And that was right after like .com.
Mm-hmm.
But it's mostly been positive. So to your point, Gilbert, like you were just talking about, the markets might have had some turbulence in the shorter term, but over the following 12 months and beyond, it seems like
it's a good thing.
Yeah, it's fairly reasonable to say it's been a positive thing for markets.
That makes sense, because cheaper money, they can take on more projects or get more earnings.
Well, they finance it, right? So like those small caps that we're talking about, if you're a smaller company and you're funding some of your operations and reinvestment with debt, you're paying a lower interest rate now, right? But to that point, thank you for that, and thank you for covering that. But to that point, Gilbert, you want to talk a little bit about the bond market, and all I'll say to segue into that is the fact that we saw this highly anticipated rate cut happen, but mortgage rates have kind of dropped off in the last week, but the bond market, and most notably the benchmark 10-year U.S. Treasury yield, actually spiked or popped back up after the rate cut. And that kind of makes you scratch your head too and say that doesn't really seem to add up, right?
Yeah, today it looks like the 10-year Treasury closed at 4.139, so 4.14. And just 2 days ago, right, the same day that the Fed made the announcement about cutting interest rates, it dropped all the way to 4% even and spiked back up again in the past couple of days. Now, from 4% to 4.14, let's just call it, because it's almost there. Doesn't sound like a big move, but that's a huge move in treasuries. That thing usually doesn't move around that much.
Right.
But to have a huge spike like that over the past few days is, I wouldn't say unheard of, but it's unusual to say the least. And you have to scratch your head and say, well, if the Fed cut interest rates and they hinted that there are 2 more rate cuts coming, that's a signal to the bond market generally that the yield curve, they're trying to force the yield curve down across the board. Now, of course, the Feds only control the Fed funds rate, so they can't really control longer term rates. But if they're cutting the short term rate, that's a signal that they would really like for longer term rates to fall or start dropping off a little bit. Now, you look at this and you say, well, that's the exact opposite of what happened. Yields are going up again substantially. What is the deal? And the simple answer is we have no idea. But there's a lot of theories out there revolving around what's going to happen. And I can tell you this, at the very least, as a taxpayer, you, Zach, me, anybody else out there listening, as a taxpayer, you hate higher yields because as a taxpayer, our government funds their deficits, all their deficits, through borrowed money. It's going to cost all of us more as taxpayers to keep funding the government deficits in perpetuity, it seems like, because they haven't really made any effort on trying to reduce their deficits. Now, as an investor, as we talked about earlier with the equity market, you have to look at that and say, well, should I be in bonds? Because as yields go up, bond prices go down, bond values go down, and you might say, well, I need to get out of bonds. Well, probably not. You need to be in some form of fixed income, but which one? And again, like equity markets, not all sectors of the bond market are the same. This is a good reason why, like the equity market, you need to be diversified, even within your bond portfolios, because the longer the term, the higher the volatility, or the longer the duration, I should say. The longer the duration of the bond, the more volatility you're going to have in price. The shorter the term, the less volatility you'll have. Now, is the spike that we've had in rates a short-term phenomenon? Are rates going to come back down later? Probably, but who knows? It's really hard to tell. So I was looking at a customer's bond portfolio. We've been talking, it's actually a prospect that I've been talking to. He's got a mix of bonds. He's got some really short duration stuff. He's got some intermediate stuff. He's got some international. He even has some emerging market bonds. Very well diversified across the bond spectrum. And it's, if you look at his portfolio, it's actually done reasonably well. It's a hedge against the volatility that typically happens in equity markets. And you need to really think about those things. The other thing I'll throw out there today is that with the equity markets at all-time highs, now is a really good time to reevaluate your portfolio and decide, hey, do I want to go through the volatility that is likely to come the higher this market goes? If you don't, there's some ideas that we can present to you and show you to mitigate some of that. And of course, the ideas are different for everybody. I'm not going to talk about a specific idea, but there's a lot of ways that we can help protect your downside the higher this market goes.
Yeah. I think that's becoming a more and more frequent topic that we're talking to people about. So I think that's a great spot to end. Thank you guys for tuning in. if you know of anybody, whether it's yourself, family member, or someone out there that needs to talk to somebody and just get a second opinion, we never charge for consultations, and we're always happy to just help and just talk. So with that, we will leave you guys for the weekend and the week. We'll catch you back here next week. Thank you for tuning in. Don't forget, interact with us, share our content. We're on Facebook, LinkedIn, and YouTube. Securities and investment advisory services offered through LPL, a registered investment advisor, member FINRA SIPC.